All right, there we go. The countdown is winding its way down. Three, two, one. Here we go. Welcome, everybody. I am live from Pennsylvania, Altoona, Pennsylvania, just outside of State College. We're visiting my in-laws as the summer winds down here, but the good Lord willing, I've got some good internet, and hopefully it stays strong. And holy cow, just rub it into all my Southern Nashville friends or Scott. It's like 78 degrees here, legit outside temperature right now. I'm
Dude,
sitting outside and not even sweating. Try to beat that, Scott.
it's 97 here today. I mean, and the humidity's through the roof. So,
Oh, it's just gorgeous. My father-in-law's house is very pastoral. Everybody, there you go. You can meet
like
Jen's
that.
dad. So I'm enjoying the time here, and unfortunately, I've got just the one monitor. So that'll be exciting to see how we do that. But we will overcome. We will adapt and overcome. All right. So I think Chris is going to get logged in here. I met with him earlier today, and at least he was intending to be here. So I assume he's fighting his own internet demons, and we'll be on shortly. I want to start off with a little rant I posted on the Facebook, and that kind of triggered some heated, what do they call it, intense fellowship, I guess. And I posted it in the Discord as well. And then Scott can use my rant and bring some common sense back to us all, because I think he's got some really good things to share we were talking about earlier, and just giving us a sober-minded perspective on the market. But I really don't listen to the news. I could care less about the news, but I have some market briefings that I subscribe to. And of course, the interest rate is all the talk of everywhere. The second quarter GDP contraction is all the talk everywhere. The White House redefining GDP, which let's be truthful. It doesn't help if you rant and it's just all opinions. Like, I really always try to speak truthfully, and if something is an assumption or an opinion, y'all can call it out. I give you pre-permission. And it is true that there are different ways to ascertain whether we're in a recession or not. If you go to the St. Louis Fed ticker, or not ticker symbol, URL fred.com, or I think it's maybe fred.stlouisfed.com, whatever, just Google Fred. And you click on a chart, and it shows little gray recession bars, and you say, how do you define the recession? It'll say it's the N. I always mess this acronym up, Scott. Is it the NERB or the NREB or whatever? And it's a broader, more in-depth look at several economic indicators, and then they decide when the economy is contracting. And so, to the White House's point, it takes into consideration things like unemployment numbers and salaries and whatnot. However, everybody and their freaking brother has used, for as long as I can remember, 2 quarters of declining GDP as the sort of back of the napkin way of figuring out if we're in a recession. And somebody can fact check me on this. I had trouble finding a specific resource that did this corollary. Maybe we should do it and we'll go viral. But I am not aware of a time that we had 2 consecutive contracting GDP quarters and it did not trigger a classical recession. Now, sometimes it's delayed by a month or two, and that can be weird. So if you go and Google, what were the US recessions, you'll find different dates. And that's because some of them are the 2 GDP quarters, and some of them are the NERB, or this can drive me nuts. Hold on.
It's NBER. It's never.
NBER, never. Yeah, I won't forget that now. That's good. And y'all can Google Neber, and it's nonpartisan. I think what they do is great. And so my point in saying all that is, my hunch going into today was that the White House was trying to get ahead of some disappointing news. Now, interestingly enough, if you haven't seen it yet, the Q2 GDP came in at a 0.9% contraction in the second quarter, which is kind of what everybody was expecting. There were a few analysts that were expecting a slight growth, but no, you'd be crazy to think that the economy was just rocking in Q2. So it was kind of a snoozer as far as the market was concerned. And I revealed in Discord that I may have taken a speculative position, because I really thought it could be a doozy, and that's why the White House was working so hard to get ahead of this thing. But here's my point in bringing all of this up. And you know, if you feel a little bit frustrated, I just want to validate that frustration, and then Scott's going to speak common sense to all of us. But in my opinion, and I shared this, I mean, go back and check the recordings. It's got to have been for 4 months now. I've been saying all along, the issue with inflation is not the consumer side, it's the supply side. And I'm not against the interest rates going up, and I don't even hate the Fed. They have one lever to pull. That lever is called interest, and they're pulling that sucker. But the rate that the interest is going up is not unprecedented, but it's fast. And to Scott's point, I don't know, a month or two ago, we've got a long ways to go until we were looking at interest that we saw even in 2007, 2008. So I'm not saying it shouldn't reset, but what I am saying is I think we're pulling the wrong freaking lever. The price of your eggs has not doubled because people are trying to buy twice as many eggs as they were before. The price of eggs has doubled because the price of feed has doubled, because the price of gas has doubled, on down the line. And you can point the finger at whoever you want to at the end of the line, whether it's Russia. I don't think we all really believe that. We're one of the richest countries in oil. Okay, we don't want to tap that. We're one of the richest countries in nuclear energy, but we don't want to tap that. It's like a self-inflicted wound. Okay, but let's just call it what it is. And in my opinion, this is opinion, we're being punished with these increasing interest rates for a problem that we did not cause. This crazy supply chain shortages. Furthermore, yesterday, I don't know if you guys caught this, but there is consensus in Washington to now pass a whole new spending bill, because that really worked well last time we did that, and to impose these additional taxes on large companies. Again, I'm not here to have a conversation about whether large companies should be taxed or not. Everybody pay their fair share. That sounds great, kumbaya. But I'm just asking the timing of this right now. Do you think applying a 15% mandatory tax on large corporations is going to decrease the price of goods or increase the price of goods while simultaneously contracting the labor market? I mean, I think if you were going to orchestrate a recession, this is kind of how you do it. And, they can say it's not happening all they want, but here it is. So the question is, what do we do with this information? And I think Scott's got some very actionable, practical thoughts and conversations on this. But to wrap up my rant, I meant what I've said for the last few weeks. Getting the current economy defined as a recessionary economy is like going to the doctor and saying, I figured out my body hurts because I tore my ACL. It makes sense. The reason your pocketbook hurts is because we've been in a recessionary economy for 6 months, and the markets are always forward looking. Go back and do a little research project for yourself and overlay recessions on your chart, and you will find that the market, and in almost all cases, not across the board, but in almost all cases, the market bottomed and started back up before the recession technically ended. And so I was chatting with family, as they often like to do when you come to visit, like, oh, let me ask you all the stock market questions I've had since we saw each other. And my opinion on this is, I think, it could be wise to be cautiously buying into the market, because at some point, we're 6 months into this. Recessions last 6 months on the short side, 18 months on the long side. Somewhere in the next 6 to 8 months, I would guess, just from a calendaring perspective, the market's going to find the bottom. Maybe it's here right now. I hope it is for everybody's retirement accounts. Just with the information I can see, and I'm not Wall Street, I don't have the magic ball. I just don't see how the numbers add up. It doesn't make sense to me. And while I'll never trade off from intuition, there is an element of common sense where if it's like, this isn't adding up, this isn't making sense, given some, bombshell report that comes out of things we're not aware of, I'm not convinced we're at the bottom yet. But Scott, I know you have a little different opinion, and that's good. Controversy is good. So what say ye to all of us professional investors that have maybe over leveraged on the bearish side, and we're licking our wounds for the last week.
Yeah, I'm glad to see you enjoying the nice cooler weather up there, by the way. You said it south, I'd appreciate it.
Softening the blow.
All right, so let's dig in. All right, so so many thoughts in my head. I sent something over to Josh and Chris earlier today, and it's because of what I'm personally dealing with the pros I work with, and just different levels and a lot of feedback, and then hearing stuff that they're hearing and just putting this all together. So let me show you something short here. Before I do, I know Josh isn't know what's coming, but I got to show this chart really quick. That's the Dixie. That's the dollar. I know he's had to deal with this with his family of the dollar's weak. Okay, yeah. Well, I mean, I'm just going to leave that there. I understand relative to other things, they can have that whole conversation, but I just want to point that out. All right, so let's dig in. So here's what's happened to a lot of people in the markets, and I'm talking professionals. A lot of them, awful lot of them, they wanted to come in a whole lot lower, guys. Like they knew we were supposed to go higher at some point, but they wanted to pick it up lower. And they know that earnings are horrible. All you guys got to look at just the major names, and earnings are just bad. Repos, from what I understand, car repos this year, the first 6-7 months, if the data's right, and I don't know this for certain, so I hate saying something I can't validate yet, but supposedly it's the highest number of car repos recorded history. I don't know if it's true or not. I hate to say that and then not know, but I'm hearing other things. So the channel check when people's businesses are just, certain things are just drying up. So what the Fed is doing is working. The bad part is it's working in certain ways where it's literally destroying businesses. It's killing the demand for their businesses, and not in a good way, like a very unhealthy, not a throttled, moderated kind of way. Not if I grew up in the, had my first car in the 80s, mid 80s. Car I owned at that point in time was a Buick Regal Grand National. They had a governor on it that limited it could go over 124 miles per hour because the tires they put on it. Of course, I changed that because, well, that's what you do. Anyway, so the same thing, the economy. Now the Fed has completely missed the boat. We know they've missed the boat. It's not a debate we've missed the boat or they've missed the boat on this. Now they're trying to play catch up. And unfortunately, they're trying to hurt things in the process. Why do you care about this conversation today? Because all I've heard again and again and again is, well, the market has to go down because of XYZ. But yet I know with what we've talked about in here, what I've dealt with Traction and Traction Pro Group, private clients I deal with, we've talked about different aspects of this. We've talked about breaking the green line and the raindrops. Like if you don't know what this means, it's like you can see things turning. The pullback on the pivot concept that I teach in Traction, everything that I teach. Then you look at, you had a 5 deviation drop. We know because it's documented actually in this form before all this started to fall apart that day, because Josh has a text about it. Here's my point. A lot of people with really smart money are still short the market, and they're getting hurt because they didn't think it could go higher, and they're not obeying their stops. And they keep thinking it's going to go lower because earnings are horrible. We're technical recession. All the reasons it can't go higher. And I always remind everybody, Wall Street, if you think about it, is a forward-looking mechanism, a discounting mechanism. It is that. At the same point in time, there are a lot of people who are not wrong. Their timing might be off. Their macro thesis is correct. The problem is, can you stay liquid through that? And so what's happening, if you're trying to wonder why is the market getting juiced, besides the unfilled gap, which is now filled, as I remind you guys, the markets don't like to leave unfilled gaps. What's happened is, well, guess what? They've got the news out, but we're not going to be whatever the verbiage is that Powell uses. And now all of a sudden, that's all they need for a little ether on this. And you get the market in imbalance where it is more levered short than it is long. Now you're squeezing the shorts. Now you're putting a short squeeze on, and it's pushing. What did you think was going to happen? Like I'll ask you guys this. It's the same conversation people I work with. What did you think was going to happen? There's an unfilled gap. There's nobody where that blue box was, because that's been posted through here, Traction Pro. Privately, funds have seen it from me. What did you think was going to happen? You get the right catalyst, you get everybody on the wrong side of the equation of the boat. Now we go to this side of it because everybody's saying, but this is all the reasons. And so it brings up the point that I was telling Josh when we were communicating earlier. Are you trading what you're seeing? Are you trading what you're thinking? Price is truth. And a lot of people, a lot of smart money is on the wrong side of this trade right now. And what happens is, oh, it'll come back down. It'll come back down. It'll come. I know it will. If you knew that, you wouldn't be on the wrong side of the trade to begin with, if I'm being quite frank about this. And this is not anybody in this group. It's just or listening to this, whether it's now or in a year from now. It's just reality. Anybody that's in traction will tell you, I say, your job is risk manager. And the sad thing is I know people who could have been out of these trades who are still short these trades who don't need to be short. And that's what's hard to watch. I know several people in that position right now, because what's happening is you're going back to your chart. Again, we covered this. 5 up, 3 down the wave count. You're at the middle of the range of the fib zone on the slope. What did you think was going to happen? I even made this point on YouTube. If I take a fib of this and I take this high and I drag it down the low, there's your 76 or 23, however you want to mark this. Let me throw one thing at this. I asked the question, even if I agree the economy is trash, doesn't matter what I think. It's not whether I'm right or wrong about the economy. It's, was this going to make me money or lose me money? If I asked you, I'm talking mostly day traders in this comment, but I took it to the longer term. If I showed you that picture right there, and I showed you that was a shallow retracement of a strong trend, and you're a day trader, you'd be getting along that. Now look at what you have right here, and people don't want to see it. You got a 5 wave count up with a 3 down, that's 8 count. You're at the mean, you're at the fib. The market's lining up for at least a bounce. I didn't say it's a bottom. It's not what I talk about. If that wasn't enough, I know that we cover this in here because Josh and I went back and forth. My third arc, my creation, that's a 0-point turn. It's documented in this form. Documented because we had to go back and forth. Who was closer, me or Josh? You have not come back there since. So that's a 0-point turn.
I feel like I was closer.
You and your horseshoes and hand grenades. It's okay. You'd be wrong once in a while, Josh. I know. Oh. I know that hurt.
Yeah, so, once I thought I was wrong, but I was mistaken.
Just got to stop. Guys, if this continues, there's a waterfall decline. Where did this break down from? Go look left. Realize there is ether on this one being sprayed in the fire just constantly right now, because everybody keeps things to go down. Then it pulls down vertical too sharp. They come in, they buy it. In fact, in Traction Pro this morning, I showed what we're using, the thing I teach in that, showing, we've been talking about since last Thursday about them carving for the turn. It's all documented, not hypothetical, not hindsight. The only thing for you is, are you day trader, swing trader, investor, whoever you are? But people thinking it can't go because of all the, as you heard Josh say, he doesn't watch TV. But you hear all the noise because we're just that tuned in. Turn off all the noise, the signal noise ratio, turn off the noise and look at the actual signal. What is price telling you? Is it making higher highs and higher lows? Are they expanding or are they contracting? And until they're done contracting this, you're not going to roll over. Yes, we're at resistance. You have to make a decision. Do you want to scale some off, or do you think you can climb a little more? Are you trading options? We've watched this play out. And yes, there's 2 unfilled gaps below this. The reason I'm hammering so hard is because I hate to see you guys lose money. And I hate to see people I work with where I'm basically saying, this is not going to work out like you think it is. It's not me personally. I'm saying the charts don't tell me that. Learn to read price action. I was asked by somebody yesterday who's in Traction and Traction Pro, worked with for quite a while, who wants to work on a specific aspect. And it made me think something I would love to do in here one day. If we get the time, we'll take an hour and we will do price reading, how to read price, how to improve your ability to read just price, nothing else. No channels, no MACDs, no moving averages, no training wheels on the charts, just pure out price, support, resistance, and trend. You could spend the next year of your life and do yourself a huge favor if you just learn to read price. That's what over 40 years, since 83, I started as a kid. I've developed my skills by learning to read price, understand slope. And the thing is, it's been documented over and over. And so I don't say this in any kind of arrogance. It's like we're documenting, I'm showing, I'm teaching, I'm telling. And it's hard because those people get hurt. Wall Street makes plenty of money. For the rest of us out there, especially smaller traders in the world, there's a lot to learn, and the market rhymes, but it's not always the same. But if I don't want somebody to come away from the day and me going to this and saying, "Oh, so what you're saying, Scott, is the bottom." I didn't say that. That's not what I'm implying at all. Nor am I trying to say I know we're going next. I really hope we get on the retracement. If this thing lets go of this mid range at some point, you're going to see this here. Do I think there's lower prices in the future? Of course. Do I think we're still going to 500 S&P? Yes. You can't have both ways. Yes, I can, because I know both are in the cards down the road. I just don't know the timing of it yet. And I don't say that to be irritating. I'm saying that like I have cases for both scenarios. You play the hand you're dealt. You trade the trade you can trade when it's available, and you have to take that. And your job as traders or investors is to make that analysis in the real time. It's painstaking for me personally to see people lose money. I hate to see it. I don't mean taking a stop loss. I'm talking where you didn't obey your rules, and everybody in Traction will tell you I hammer this, because all it takes is one bad trade to ruin 2 to 3 months of productivity because you wouldn't take a stop. I cannot hammer this hard enough at people. That's why 40 years later, I'm still around doing this. And it might be part of the reason you're listening to me. I've learned from my mistakes. And when I disobey my stops, it's always, it doesn't matter what the noise is coming out of the media. Tune it out. What is your chart telling? Because that's where the real money's going. So there's my rant.
Yeah, it's a good rant. And so I've been thinking about this, and I have so much more experience under my belt now than I did in 2008. I mean, I was like, in terms of dog years, I was like a baby trader in 2008, and candidly got lucky. I've shared that with you guys. And so I was thinking, like, how do I play this professionally, not luckily? And I'm going to throw that this is like a lab, right? This is just kind of our testing ground of ideas. So I'm not ready to put this in a keynote presentation and sell it. But I'm just playing around with this idea of giving myself permission. Like, it's like, okay, I see the candy over there. I'm going to go eat a piece of candy. I just don't have to eat the whole freaking bag of Skittles, right? You can have a little bit of candy. So I've taken this speculative bearish position, and mostly just so Scott will feel really good about himself when he says, "I told you so." But it's like, all right, for me, even if this thing loses $500, like that's nothing. I don't mean that arrogantly, just in the world that I'm in, it's $500, but it could turn into $5,000 if this trade works out, as I'm hoping. And that's a much different word than you guys hear me use typically. And so I was actually chatting with Burgess about this. I think he believes I'm a little bit crazy, but that's okay. What if there was an opportunity to design a strategy for ourselves that said, I'm intentionally being a speculative trader, which is not my strategy. I mean, I guess at some level we're all speculative traders, so don't take that too literally. But I'm taking a risky trade, and if it fails, I'm just going to put $500 back in my account, so I don't have to deal with the drawdown. If that was $50,000, that's a bad day in my life. Like that one hurts. Like, sweetheart, I gotta go take 50 grand and put it back in the trading account. But 500 into 5,000, that's a risk I'm willing to take. And it kind of sent me down this road of like, maybe I should treat all my trades that way. Like if I've got a $100 R and I lose an R, just put that cash back in there, because then you don't go chasing after the whole, well, the market took my money and I want to get it back, or trying to overcome, like, return that 1R, and just jumping into trades prematurely. And then Burr just called me out and he was like, I think you're trying to design a strategy to compensate for your perfect win-loss ratio, or lack thereof.
Wow. Ouch.
Yeah, I mean, we'll just be I mean, I'd say the good and the bad. Like we were on the phone. I might have told him to read between the lines. You get it? Have you ever seen that?
I already knew as
Read
soon as
between
you said where you
the
were going.
I'm just innovating here. Like, I want to believe that the economy is as bad as it feels. And like I don't
But
know.
why? Wait, but why? Wait, hang on. Bear with me here. This is a really good learning moment for everybody. What is it in you emotionally that is so attached between what you're? Here's a saying. This will help. This will really solidify this. For everybody that's been married, whatever. What are you told as a man? Do you want to be happy or do you want to be right? Do you understand? Okay. The same thing for Josh right here. Why do you want it to be a certain way? And why is that influencing you and your decisions? Because y'all are seeing this is what happens to a lot of people. And I'm not picking on Josh. He knows this, but you're hearing what he's expressing to you and he's trading positioning based off of that. I'm not saying that's right or wrong, but if the price proves it wrong, what do you do? You stop out. That's not about Josh. But how many of you can relate to what Josh is saying? You know it's bad. You see the headlines. Well, then why is the market going up, Scott? Well, when things weren't so bad, why was it going down? You've got to realize the market's leading and your emotions are lagging just like a moving average. I've been there. That's why I say this. I'm trying to help y'all. But you have to ask yourself, as Chris brought up to Josh, is it to be right? Or are you trying to be consistent and profitable? And again, that's not it, Josh, not you profitable. I won't make that point.
I figured it out, dude. Like that's a great question to ask. That's a really quality question to ask. And it's FOMO. It's fear of missing out because I made so much cash in 2008 as the market was crashing. And y'all, if you didn't live and trade through 2008, like this is the appetizer, like what you've experienced for the first 6 months of 2022. That would be the appetizer of 2007 going into 2008. And I think I'm trying to relive history. That's exactly what it is. It's a great question.
There's a saying, when you ask a question, the brain has to find the answer. If I say, Josh, what time is it? Crap, Scott, I don't know. Right? Immediately your brain goes search for the answer. The thing with traders, we can often trade our emotions and not the facts. That's why I say trade what you see, not what you need. And unfortunately, we're seeing that hurt a lot of people. The difference is the psychology this time of it all is what's wiping people out. I want to show you something though, while we're on, because you just brought, crap, sorry about that. Hang on.
Rookie mistake.
Hang on. I want to show this really quick. Because Josh brings up a good point. Is this like 07, 09? Is this what we're dealing with? And I got to clean this up again. Just indulge me 1 second. Remove all this junk that you guys don't care about. All right. And let me take this off just 1 second, because I want to show you something that I look at, and we've taught this for free several times at the webinars and all this. So this is the Bollinger Band, right? All right. So this is my daily. All you care about right now is where your relationship to being below the blue band, the very bottom one here. Now here's the weekly. See where we just hooked? See the slope of that? All right. Now let me go back in time with you. Put more data. Just indulge me here just 1 second, please. This is just something. It's just one thing I've looked at for a really long time. And it's how I know when things are getting really bad. So you can see the hook off the Bollinger there. Very, very, very well served. Let's go to 07, 09.
Yep.
One of my best friends in the world had a big disagreement with this right here. I wound up being right. He wound up being wrong. And this is what happened. Again, it's not arrogance. No different than some other things I could address with a very well-known Wall Street firm published in the Wall Street Journal telling them what the exploit is on the floor to stop trying to get long the market. That was right about here. That means downdraft. If you go the weekly, are you in a downdraft right now? No. Have you sold off a solid 3 waves? Yes. Are you at a level of support with an arch slope? Yes. I've showed you the monthly chart. I could do this, you guys, all day long. There's a reason I have the tools I have. I've been doing this for 40 years. I am not a genius, nor close to it, but I can at least look at things and see them. And what I have to do, what I've learned, probably starting in the mid, I don't know, I would say the early 2000s, because people I've been around, I learned to shut out all noise. There's not a TV in my home right now streaming anything with financial media at all. I look at my charts. I tune out the noise. Yes, I will see CNBC's headlines about whatever's at the moment on occasion. I've turned it off. I go to my charts. I'm a trader. I'm an investor, whoever you are. Focus on what you see, not what you're thinking. Does your system tell you? We're about systems. Josh is all about the R's. If you're about your R's, you are a risk manager first. What is your entry? What's your stop? What are your targets? Do you have a setup? Do you have a frame? If you don't, what are you doing? Ultimately, as Josh said, we're here to make money. Tune out the spectrum, everything else. What happens is you get caught like a deer in the headlights, guys. And that's what cripples you as a trader. I've been there. I've had it so many times happen to me. And what I've learned is, as soon as the news is out, I've got to respond. All right, what does this mean going forward? What's your chart telling me? Where are my entries? What's my frame? And then go to work. That's my job, or I don't get paid. It's that straightforward. To think it's anything else than that, it is. But honey, I can see Josh telling his wife, but honey, I'm right. And then she's mad, and he's like, ooh, happy wife, happy life, right? Do you want to be right, Josh, or you be happy? It's like, oh, I'll be happy. Take that same analogy to the markets now. Do you want to be right about the economy and about the recession? Great. Is it going to make you money? That's the bigger question. If it is, your chart should tell you that. And even with the people, I'll throw one thing in here while we're here. I covered this morning in Traction Pro. They know what all this is. This on the right hand does not look like .com or '07. Nothing I have looks that way. Could we have a black swan? Of course we could. But I have to have a system I trust. This is what we teach in Traction. Anybody's still curious about that? But that's why I have to have something I trust. And I have to follow that. I have to have a system, just like going to Chick-fil-A. How do they always end it? My pleasure. You have to have a system. If you don't have it, you're at the whim of the market. And anybody who's traded as long, any decent amount of time knows what I'm preaching is the truth, because you've been there. That's why, anyway, Josh, chime in. Like I said, we could do this for the next 10 hours, be the same song and dance.
Yeah, I was just updating my charts, looking at yours. Those of you guys who are here live, by the way, I hope there's not too much wind noise, that the wind picked up a little bit. I mean, it's not like Scott and I sit on a prep call and get ready for this. We're just sharing with each other, and you guys get to be a fly on the wall. And so I don't disagree with anything that Scott said, but another way that this could be looked at, pause that train of thought, the underlying issues of 2008, 2007 are totally different than they are currently. You had, the too big to fail world, where banks and major car manufacturers were about to go bankrupt and the government decided to bail them out. Like, we're not in my opinion, we're not in danger of seeing those credit markets collapse because of the policies that were instituted after the 2008 collapse. You can't go out and get 110% mortgage now. I mean, I suppose in some cases you can get up to 100%. I think VA is one of them, but generally speaking, you can't. But looking at this chart, so this is the monthly. I'm on the Dow because this is just where I had notated the recessions. So it's going to look a little bit different than Scott's SPY chart. But we could put a gray box in here right now. We're currently in a recession, and looking at we've come on down to the Bollinger Bands, coming back here to 2007, 2008. There's where the recession started. In my opinion, we could be sitting at this point here in the move, and Scott hit the nail on the head. Like, what is it in you, Josh, that is so anticipating additional bearishness? And it was the memory of this, because that's where all the cash flowed into my jeans. So I'm just looking at this here saying we're bouncing off that bottom Bollinger Band. I don't know, maybe it'll go up. I hope it goes up for everybody's retirement account's sake, but it could also go down, and it would not be, from a pictorial perspective, it wouldn't be that different from 2008. Is that crazy, Scott?
No, I didn't say this. I don't want to cut you off, but I just want to ask something. The middle of that Bollinger, so we bounce up to that Bollinger, and it's like, okay, we try to go higher, then it pulls back and it starts to wind over. It's what I've seen so much of is the sky is falling. I'm going, but it's not. I understand we're over 20% down and we've got bear. I get it. So the question is it what's the right phrase? Well, I can never think in my head, but like, is it a cyclical bear and a raging bull, or what are the, I can't remember how the phrase goes. Forgive me with that, guys. But it's like, is that where we're sitting against? Is this just the NASDAQ overcompensating, overcorrecting because it's gone up the most? And I've demonstrated this in classes in the past few months. But Josh is not wrong. This can transition, but it's a long-term chart. It's not right here, right now. And you had 3 completed waves down. So we needed I hate to call it relief rally. We've gone too much vertical. We need to walk either up or to the right and offset this, and then we'll go from there. Yeah. He's not wrong, guys, and what he's trying to say can happen. But it's just a context of, this is what I want to stress with everybody. Josh, you're right. In the next, let's just say 6 months, 8 months, we're half this value. I'm not even saying that's not possible. I'm not trying to get to that level of discussion. You all have to pick your timing, and each of you individually. I know people who are scalping, making great money the past few months. I know people who are positioned and they're getting crushed. But ultimately, you could all be correct. The only question is the frequency. How long are you going to ride the wave? That's it. And which wave are you riding? That's the thing I want to hammer home, everybody. That gets missed a lot in these conversations, I think, for people, not just us, even when I'm teaching. What's your frame of reference? That's everything. And Josh could be positioned short and saying, hey, in a year, I think we're a lot lower in here. He's probably right, but we'll have to wait and see. And the timing is what kills everybody. That's where you make or lose your money, right? Anyway, Go ahead, Josh. Sorry.
Yeah. No, that's the whole game that we're trying to play here is, as technical analysts, is clarifying the timing of all this. The last point I'll make, and then I'll move on, because Johnny asked a really great question in the Zoom room, and I want to make sure we get to that. But if we take the smallest, most marginal pullback that would be acceptable, in my opinion, this is still a monthly chart, and from the high of 2022 to the low here of COVID, this last wave up, in my opinion, we've simply pulled back to the minimum viable target. Like this is not the destination. This could be a rest stop, like it could come on down to 50, like that still makes sense. It could come on down here. And even if it broke through that bottom fib, we could say, okay, it's the larger range. Let's go back to the beginning of this original gigantic bull trend that we experienced. If that's the case, we're looking down here. So again, like it's the weight of the evidence approach. And timing is everything. So I will come back in 6 months and tell Scott I was right, because that's just how our relationship is. But it may take that long to get down there. I don't know. But, my question is, given all the things that we know, is the very most minimal retracement likely, or is potentially a little bit of a larger correction the more probable cause? And I don't know. I'm still sitting with a bunch of cash on the sidelines, and I feel like if I had a lot of cash in the market, this little rally for the last couple of weeks is a gift to maybe put some of that cash in your jeans and then just wait and see what happens. I mean, a month isn't going to kill you sitting on the sidelines, unless there's a tax implication. Do know if you pull your money out less than a year, you're going to get taxed short-term capital gains, which is your earned income rate instead of long-term. But it's a really very, very interesting conversations. Now, individual stocks like Josiah, my son, you guys know him. He took his very first real money trade. He bought AT&T, and this whole thing is interesting because he bought right here on this candle, and we were kind of having a conversation about, I'm like, buddy, it's definitely at a low that it's been at, his lifetime. Really, it's never traded lower. So like AT&T is probably not a bad buy. Let's build up a position. You can sell some covered calls on it or whatever. So, and there's a lot of stocks like this. Ford was another one I was looking at this morning. There's a lot of stocks that are really nearing some key support levels, and it's the conglomerate of those stocks that are going to start offering support for the overall market. And we're not looking at Enrons plural across the board. That would be crazy. So at some point these stocks find support where people are like, I don't know if it's going up or down, but I sure wouldn't mind loading up on some Ford stock while it's cheap. Let's take a look at it here. Look at that. $13 for Ford right now. I guess back when market crashed, it was down to 4. So you're still doing, I didn't realize it had gone that low. I don't have Ford in my portfolio right now. But point being is a lot of stocks have pulled back to levels that are getting attractive to people.
The relative value trade.
Yeah, exactly.
And one thing I want to bring up before he shifts gears again, guys, is the macro versus the micro. The big thing is we can be right in the much longer term that the market is going to be significantly lower. But from a timing perspective, that's the ultimate thing, because can you withstand the drawdowns against that? And that's what gets people in trouble. And I know that, y'all know that, but I just want to stress that are we macro forecasting or micro? And I say macro, are you trading the long-term setup? Or are you trading a short-term setup? And that's all relative to each of you and your time frame. So, I completely agree with Josh. It's just the timing of when that particular cycle is going to kick so I can get the maximum return. If I'm trading options, I don't want to have to live through that kind of noise, right?
Yeah, none of these trades are options. That's a great point.
Just so everybody's clear, right? Yep. That's where that timing factor, you all understand that. And that's why what Josh is showing you right now with whether it's Ford or AT&T. Are you buying shares? Are you buying leaps? What's your... And each of you can make that decision as a professional trader or an investor, whatever it is. So just a little clarity.
Options, unless you're doing selling strategies, which Bird just cleaned up on Tuesday. I don't know if I forget how public. I don't know if he shared it all on the Discord channel, but he crushed it. I think he beat my best trading day.
Wow.
But most of his option strategies are selling strategies right now, and that's a whole different ball game. But Johnny, I want to get to your question. And Sorties, I saw your question. I don't know why Zoom has disabled chat. I did not change anything, so it's just being Zoom. So Johnny's question was, I'll read it. When looking at MACD and stochastic, thank you for saying stochastic correctly, by the way. 10 bonus points to Johnny. It's not stochastics plural, it's stochastic singular. All right, so between MACD and stochastic, if divergence starts to show on MACD, will it also show on stochastic and vice versa? So to explain that, I want to do a quick run through. Am I still showing my screen? Yeah.
Yes.
You guys can see this? Okay. I teach this in Foundations of Trading Level 2. We'll just rip through these slides quickly to understand the difference between stochastic and MACD. And then that in turn will answer this question. So stochastic, created by George Lane, it compares the closing price, recent closing price, to a price range over a given period of time. There's two lines, the percent K, which is the actual stochastic line, and then the percent D is a smoothing line of that stochastic line. And when you hear smoothing in technical analysis world, that means it's a moving average. So the common setting for this is 14, 3, and 3. And this is what I want to get to. Here's the math calculation for stochastic. I'm getting all my Zoom windows out of the way so I can see. Percent K, which is a stochastic line, is 100 times CP minus L14 over H14 L14. What's that mean? So closing price is CP minus the lowest price of the previous 14 periods divided by the highest price of the last 14 periods minus the lowest price of the 14 periods. So that's where you're getting the current price compared to the range, and then they plot that each day, and you can see where it's going. Practically speaking, there's the D line. I misspoke. I said D was smoothing. That's not true. It's the high of the last 3 periods with the low of the last 3 periods. Here's where it gets practical. So stochastic is range bound between 0 and 100. It'll never go negative, and it'll never go above 100. Typically, overbought is 80, oversold is 20. Overbought and oversold levels work well during sideways trends. And stochastic crossing up through 20 during a bullish trend, which we're not really seeing right now, is often a good signal. So the piece I want you to take away is closing price compared to a range of prices. Now let's zip forward to MACD. I want to get to the creation of this. Did I not put that in this one? So MACD, shoot, I don't have that in this slide. MACD is the relationship of moving averages. And I believe it's the 13 and 21 period. No, it's the 12 and 26 period. Exponential moving averages, the relationship between them. So if it gets wider, the MACD goes up, as you can see down here in the blue line. And if it gets shorter, that blue line goes down. And if they cross, that's when the MACD line goes down below zero. So MACD is giving you a, what would I call it? It's like a derivative reading of two moving averages and simplifying it and putting it on one line. So to get to the answer, they're calculated totally differently. You would not necessarily see divergence on stochastic when you see it on MACD. However, the situations that set up divergence on MACD often will create a divergence on the stochastic as well. All right, so it's not a thing that I'm aware of. If there's divergence on one and not the other, or if there's confirming divergence, that's not a thing other than it adds to the weight of the evidence. Now, I have seen some divergence. I think Starbucks was one. So let's take a look at this. Starbucks divergence here, right here, perfect. So lower lows, higher lows on Starbucks. This is MACD. And just for fun here, how am I doing on time? We're doing pretty good. Let's do moving average expo, put 2 on here. And this, like, I always think this is cool. People think I'm a nerd, but that's okay. I think they're weird. 12 and 26, let's change this to a different color so we can see it. So if our theories are correct, where the 12 crosses the 26, okay, these two exponential moving averages up here, where that crosses over, the blue line should cross through the 0 line here. So let's put that on the cursor on there, and you can see that, of course, that's true. And then same thing here, as the blue line gets further away from the red line, the 12 gets further away from the 26, down here, the blue line should get further away from the 0 line, which it's doing. And then this orange line on the MACD is the smoothing line. That is the moving average, 9-period moving average. And then the histogram is the relationship between that smoothing line and the MACD line. So what we're seeing here, what this is telling us is that, yes, the 12 is further away from the 26, but here in May, it's less far away. The gap is less than it was back here in March. This is wider than this right here. So we're making lower lows in price, but higher lows in terms of MACD. Now let's see what that does with stochastic. Same period. Okay. No divergence per se. In fact, if anything, it's coming on down here. I would weight much more significantly divergence on MACD over the stochastic oscillator. That doesn't mean I would negate divergence if I saw it show up on stochastic. I'm just not worried that it doesn't show up here. And I actually talked about this in a power trader. I think it was not the last one I did, but 2 ago, which I have no idea what that date is. So you can just flip through them. But I was looking at stochastic, or excuse me, I was looking at Starbucks as a bearish trade. And I saw that divergence on MACD. And I was like, whoa, no. And then we put this resistance here, and we actually had a trade. We said if we get above resistance, we would actually be bullish on stochastic. And so that was the benefit of seeing the divergence show up on MACD. So did that answer your question, Johnny? He probably is like, you answered that like way too much. But I mean, I felt really good talking about it because I think it's fun and nerdy.
You did great.
Let me check YouTube and see if there's any questions on there. No questions on YouTube. We do have a couple people watching. So if you all have questions there, feel free to post them. How often does that divergence play out in price action to take the trade? So this is really timely with our conversation about market timing today. I would say divergence is a very strong signal. I hesitate to give it a percent win or percent performance because I don't know what it is, but I would say certainly well above 50%, between 50 and 80%. So let's say 70. I said I'm not going to give a percentage, and then I did. See what I did there, Scott? I'm like a politician.
I know.
The problem with divergence is it's a terrible timing indicator. Terrible timing indicator. Divergence can hang on a lot longer than your account can stay solvent. So that was the challenge with MACD here. Just trading on divergence alone, like it started back here, right? There was the initial divergence, and it took March, April, May, June, July, almost into August before this really played out. Sorry, the wind is really kicking up. So I would use divergence to keep me out of a trade like we did with Starbucks and Power Trader. I'm like, nope, we're not going bearish on this right now, because it's like what's a good, it's what builds pressure, like a volcano, but that's a bad example. You know, something that is building up pressure and you don't exactly know. Oh, it's, you ever put like dry ice in a water bottle? Like my kids love doing this. You
Or
take a water,
Mentos in a Coke bottle.
yeah, or that. It's like the pressure's building and then you don't know what's going to go, and then boom, it surprises you. Like that's divergence. Like you can just kind of see the pressure building and you're like, I don't think I'm going to go grab that right now because it could blow. It might not blow, but it could blow. Pressure cooker. Yeah, there you go, sorties. Pressure. I have a funny story about that. I was a kid. I still remember this today. My mom had cooked something in the pressure cooker and she did something wrong. I don't know what it was, but like all the contents of the pressure cooker ended up on the ceiling. And like for
Oh,
5 years, we'd never, like, she cleaned it, but it was like stained up there. We didn't repaint it until like I was getting ready to leave for college. It was yeah, it's good memory. Anyway, there you go. What else? What you guys got? So this is my SPY chart short term, you know, despite everything Scott says, if you can believe him, whatever that means. In fact, I think you gave me these lines, Scott. I was like, that looks very smart. I'm going to put those on my chart. So, I mean, just considering my personal bias here, but, you know, I just see hangman coming into resistance and, you know, maybe I'll dollar cost average just so I can make fun of myself in the future self.
As you're doing that, side note, Chris just let me know he'll be here in about 10 minutes. He thought we started at noon, not 11. That's why
in 10 minutes. We'll be done in 10 minutes.
That's what I told him. He said, no, Josh said the meeting this morning would be at 12 Central. I'm just like, pretty sure he said 11.
Said 12 Eastern, 11 Central. Yeah.
That's sorry. Anyway, yeah. Keep going. I just want everybody to know why he's not here. His time's a little bit off.
Yeah, we should all give his email address out so we can send him wishes. Say sorry you weren't here. Anyway, I don't know. I mean, I'm a little bit tongue in cheek, which I guess we have to be careful of because I don't want people to take me seriously. I hope we go higher, skyward. You know, I think, and so, you know, here I'm not completely crazy and lost my mind. It's a small portion of my large trading account, and I'm thinking the probability that we go like this versus we go like this is, you know, small. I don't think this thing is a space shuttle going to the moon. You know, this week has been pretty aggressive so far. We'll see what happens, but if we get down anywhere in here, that trade is going to be nicely profitable. I'll use the opportunity to put cash in my jeans, say I dodged a bullet, and it'll be fun. And if it goes to the moon, so what? It goes to the moon, and I got to take a few $100 out of my cash out of my jeans and put it in the stock market.
Let me tell on that note for 1 second for everybody, because this is what I mentioned to Josh we would touch on. So Fed's over with, right? We've got that. I think Apple's after the close today, and I forget who else before the week's over. So we're done.
Did Amazon already report, or are they after hours? I couldn't figure that out.
I think Amazon's after hours with Apple. I think that's right today. Somebody know.
I mean, they do report today, but then
I think it's after hours.
Something I saw made me think that they had reported like right after the morning bell, which would be weird. So anyway, go ahead. I was confused on that.
No, it's okay. So I just want to address something. We're going into the tail end of summer. Like my kids start back, my daughters start back the 9th, my son starts back the 16th at college. Most of South is that way. Football season kicks off for high schools. Collegiate, I guess, is right at the beginning of September. I think that's right. Don't hold me to that because I haven't really checked. We're going to come to the end of summer. We don't have a Fed mini again for several more weeks again, right? And all the chatter going then, and earnings season's over. We're about to go in the doldrums of summertime, guys. But I'm setting that logic up in your head for everybody so that you realize what's the catalyst going to be to move the markets? Is it anticipation of the Fed? Is it that every week when the jobs number comes out, like what data is feeding into this? And I'm giving you that more macro feel because we're still getting some volatility, but summertime tends to be Monday mornings, Friday afternoons are very light, right? That's typical summertime. Previous summers, COVID and all that, everybody was glued in front of the machines. Things are getting more to normal. I'm just setting this up as you go forward to think about it. What's the catalyst to move the market? What is going to move it? Is it, this chip legislation that came through? Is it another rescue package? What's it going to be? And it's not just the US that's got troubles here. This is a global issue. We're not the only ones who print a whole bunch of money, right?
Mm-hmm.
Ukraine, Russia. If the Ukraine-Russia comes to an end, if that war comes to an end overnight, mystically in the next couple of months here, don't be surprised unless the market's already stretched. That can be a catalyst that can really, just hyper fixate the market straight up. But if it's already up there, it might be anticlimactic and then they sell the market off. But the market has more clarity on business. So, and going forward and how we'll deal with supply chain issues and whatever, I just want to get you guys thinking a little outside the box right now as we go forward here into the end of summertime. Hurricane season will start to ramp up. I know I sound negative, I'm trying to. It's more of just the reality of things that will impact a lot of commodity related type names, especially in the oil industry. One thing I did hear recently that's caught my attention, and a buddy of mine, he said it may seem opposite what you think, but the more they're pushing the green initiative, the less they're pushing drilling for oil. So why would a company, Halliburton, whoever, Exxon, Conoco, go out and do anything else because they're going to get punished, or they don't see the reason to put the risk on because the government's not supportive of drilling? So therefore, those stocks more than likely have there's less supply, so more reason for those things to benefit and go higher. You would think it'd be opposite of that for a lot of people, the way they're thinking. Continue to watch your commodity names going forward as we go into the rest of Q3 into Q4. We'll see what happens. Watch your retailers, watch Amazon and Walmart. You got to see what their charts are doing. If you're looking at retail in the US, and it's not that you're trading them, you're just trying to get a sensory perception. I'll tie it up with this. Take Tom Day a daily chart, pull up the main sectors, the industrials, the techs, whatever, the IYR, not the IYR, XLI, XLK, XLY, XLU, all those, right? Look at those. Look at your commodity type names that have ETFs and get a sense what leadership is. And this is the last thing I promise I'll add, and I'll let Josh hop back. I'm always asked, how do you find leadership? Well, NVIDIA, AMD, whatever the semis are, right? Legislation. Is that what led the market higher? So here's your homework. Overlay your charts. Take the NASDAQ or take the CompX. Put that line on the chart. Now put AMD, NVIDIA, other chip names on there. Are those stocks leading the market higher and then the ETFs are following it? Or is the NASDAQ, so to speak, the QQQ, is it leading and those chip stocks are following it? When you're looking for new leadership in the market, it's a simple way to look at that and to its underlying market. We'll just call it tech in this case. If that's the case and tech rolls over, where's the money rotating to? If there's not rotation, then the market has no buyers. There's not a risk on model, it's a risk off model. It's one way to think about it. So just a little bit of information right there to kind of help you guys, but I don't know if that helped or not, but I hope it does.
I was just trying to find, I'm putting myself on point and I can't do it. Maybe I'll post it in Discord. I was trying to find July seasonality data for y'all because it's a known seasonality phenomenon that July is kind of a reprieve and the whole sell in May go away. So July gets a little bump and then August typically pulls back again. September pulls back, and then coming into the end of September is when we start to see the rally, hopefully going into some kind of a Christmas rally. So, and I actually talked about this in Power Trader too. That's why I thought I had it in my Power Trader notes, but it wasn't there. I talked about July being a little bit of a bullish bump. So it's not unexpected. Johnny asked Johnny, you've had great questions today. Really great questions. He said, where did it go? Stand by. Is there a process you recommend to go through when looking for stocks to pick, or should I subscribe to a watch list? So, I mean, we have watch lists here at TSU. Most of the apprenticeships, Scott's, I know. Do you have an active watch list, Scott, or is it just coffee and cash, and you guys do that enough that that replaces?
Yeah, because if I see a particular sector of stock, I'm gonna harp on it pretty hard to put it in front of them. So that's kind of that been approach.
So, Scott's approach is more real time. Alfonso manages a watch list. Chris has managed a watch list in his. I'm more of a scanner, is what I look for. And there's a few things that I do. The one trade, the son of Benacci, does not work great in a bearish market. And candidly, I don't have a lot of strategies that work well in a bearish market other than old school technical analysis, and I just trade the SPY the whole way down. Burgess has more of a process he goes through, but my personal process, and this is why I think the world of indicators, because in my opinion, indicators are not to be used as a crystal ball. They are used to help you identify stocks that meet certain criteria that you're looking for. So for example, the stochastic is a great indicator that I use. Sorry, I got zoom windows all over the place. And let's just come back here when we weren't in a bearish market. Stochastic getting down around 20 or even below 20 is oftentimes a sign that a stock has completed a pullback and is coming up. And so I need more screens. You don't need more screens to trade, but you do need more screens to run a freaking Zoom call here. I got so many Zoom windows. So actually it's right here. Stochastic's crossing up through 20. I was the last one I used. So we can go look at Guild. And this isn't going to be appropriate because we're in a bearish trade here. But if this was a bullish trend, stochastic crossing up through 20, that triggers a whole new round of analysis for me. I usually start with fibs, and then I work through my indicators: simple moving average, exponential moving average, which by the way is completely sideways, stochastic, which we already know because we had that in the search criteria. Then MACD, speaking of divergence, ever so slightly, certainly gaining momentum there. MACD, RSI, Bollinger Bands, and then that's it. Higher candle closes I've been using for getting out of the trades. Scott taught us about that. And once that's done, I take a weight of the evidence approach and I say, what's the probability that I can accurately forecast if it's going to go up or down? And I kind of have a little process I go through, which we're already 2 minutes over, so I won't detail that now. We could do it next week or in a group coaching call or something. And then that, you might find this funny, but I always just take a pause. Like I never go straight from analysis into making the trade. I just take a pause and I let it sit in. And if it doesn't feel good, said nobody ever, if it doesn't feel good, I'll pass on it. Like I don't have to know why, but if it just doesn't feel right, I'll pass on it. I don't do the inverse. I don't see a bad stock and just say, ooh, I just gotta, unless it's talking about the market crashing, and then I go break all my rules. But other than that, the inverse to that is dangerous. But every now and then there's a sixth sense that kicks in and I'm like, I'm just not going to touch that one. And more times than not, that has served me well. And that's the process that I go through for finding a stock. There's a lot of other more advanced search techniques that are kind of beyond the scope of what we're doing here. I know that Burgess has got several with unusual options activity, which is super cool. My little guy standing at the window waiting for me to be done. Y'all want to see Zeke in his PJs?
Yep.
And so we could go into more depth in the appropriate apprenticeships there, but it is very systematic, it's very regimented. And last but not least, I don't believe that every stock has a trade on it every day. I used to kind of have that mantra, but I've backed off from that a lot because some stocks, it's just not a great day to trade the stock. Artificial intelligence I use as well. I'll look on the Deep Sky watch list to see what's up there, and if it's got a good sky score, I use that to find stocks as well. So not every stock has a great trade every day, but Taylor, y'all are about to meet my friend Taylor this fall, He's like a more California version of Scott. Y'all are gonna love him. He trades Tesla. It just in it's amazing. He's made six figures in a day before. It blows my mind with what he accomplishes as a retail trader. And so he trades Tesla and like three other stocks. That's all he does all day long. Is just trades Tesla. And
Specialist.
he's a specialist. And there's value in like getting to intimately know the traders of Tesla, not by name, but by behavior. And you get to know them. So, there's two different schools of thought, maybe three. Subscribe to a watch list, figure out a search pattern that will bring to your awareness stocks that meet a certain parameter or parameters, or become a specialist in a few stocks that you just love, and that's all you do is you watch them all day long. So did that give you at least some launching directions, Johnny? Good. Sorties, I don't know if you want to grab this one, Scott, because I know you and Sorties work together a lot, and this will be our last question. The charts of various companies. I legitimately don't know the answer. Not that it's a bad question. That's why we're technical analysts and not fundamental analysts. I don't know why, one direction goes the other than, I come back to, by the time you learn of the news, the market has known about it for much, much longer. It's already been baked in.
Yep.
So, you're hearing about it as like an after action report, even though it's breaking news.
Yep.
So, all right. Well, we missed our friend Chris, but we should all send him like get well soon emails.
He said we'll see him next week. Once he's like, ooh, okay, I'll see you next week.
He'll be like, get well soon. I don't feel sick. And then after a while, it'll make sense to him. But hey, a couple things, and this is at the tail end, so hopefully people are still here. Number one, like and subscribe to the video, of course. That really helps us out. Number two, keep an eye out. I'm going to be doing a class on Monday. We're launching, we're calling it the IPO here at TSU, and I'll explain what that acronym means on Monday. But it's going to be really cool. It's kind of a 3-week series that we're doing that I think you guys are going to really enjoy. And then I've got you'll see emails about this. I did this publicly outside of TradeSmart, but I think our TradeSmart community just might really enjoy it. It's called the Put Cash in Your Jeans Challenge. I created this just for fun, and it was a blast. I did it with about 500 bros a couple of weeks ago, and it literally is just designed to put cash in your jeans. It's not stock market-y necessarily. It's kind of outside the stock market, but we're going to send some emails out. If you want to register for that, you can. I mean, you're not going to learn any great stock market tip. It's what do they call that? Contra stock market. Or not contra, but it's beyond the stock market. And then last but not least, keep an eye out. We've got some new programs that are going to be launching going into the fall. You should start seeing information on those as early as a week or two from now. And I think that they're going to be very, very useful, especially as we start to go through this market transition from bear market recession to bear market bottom to holy heck, this is an opportunity like we saw in 2009, where you can 3x your account in the next 6 years, or, even if you just bought the S&P and held it. So lots of exciting things that are coming out at TSU. It's a really, really amazing time to be doing this. And we're so grateful to have you all along on the journey. Blessings to each and every one of you. I hope you put fat stacks of cash in your jeans and you're able to use that money to go out and do amazing things in the world. Scott, I'll let you have the official sign off for today.
Appreciate you, brother. Y'all have a great weekend ahead, guys. Enjoy the last bits of summer as we go through that. We will see you all here again, same time next Thursday.